All right, here we go, guys. They tell us bonds are issued at par. What if they didn't tell us that? No worries. We got a $100,000 5-year 10% bonds issued when the market rate is 10%. Stop. If this is the exam, coupon divided by price, therein lies your yield. So my coupon is 10, my yield is 10. That means the bond is going to be issued at what? Par value. So you don't have to mess with any math. You don't have to find the present value of the principal. You don't have to find the present value of the coupons. Please don't waste your valuable exam time. You know when those bonds are issued, you're going to take in the face value, you're going to repay the face value. So here, $100,000 financing inflow, $100,000 when it matures, financing outflow. But there's no need when the coupon rate and the market rate are one and the same. There's no need to find the present value of anything. Okay, so the bonds will be issued at face value, $100,000. Obviously not the case if there's a discount or a premium, which we'll see next. But it'll save you a lot of time because all this other stuff doesn't apply unless the market rate is different from the coupon rate. Okay, so you could see if somebody foolishly did all the math, well, what would they have to do? Well, 5-year term, what's our number of coupon payments? Well, how are we paying interest? Semi-annually. So 5 times 2, our number of periods, 10 periods. Remember, the discount rate is always based upon what the market rate is, but the market and the coupon are one and the same, but you take your 10%, divide it by 2, 5%. So I want to find the present value factor for the principal, the present value of 1. Remember, that's a one-time payment at maturity. So the present value of 1 corresponding to 10 periods at a market rate, periodic rate of 5%. And then my coupons. Well, I got $100,000 par value. My coupon rate, 10%, paying it semi-annually. Well, that's going to be a payment of $5,000 every 6 months for the next 5 years. So then we'd have to find the present value of the coupons. $5,000. Here's your present value factor for an ordinary annuity. Present value factor for an ordinary annuity corresponding to 10 periods and a periodic rate of 5%. So for the coupons, present value factor, ordinary annuity. For the principal, present value of a single amount. Work out your math, add it together. Here's the sum of the two. We would debit our cash financing inflow, $100,000, credit your bonds payable, and when that's paid at maturity, financing outflow. Remember, we accrue for the interest. The principal's paid one time at maturity, no payments of principal until maturity. Initially, this $100,000 bond payable, well, that'll be long term until we're within 12 months of repaying it. Once we get to within 12 months of repaying it, then it'll go from long term to short term current liability. Piece of cake. All right, now let's take a look at the next one. Alrighty guys, now we have bonds issued at a premium. They're insulting us. You don't need to tell me it's a premium. I can figure that out for myself. Coupon divided by price, yield. You ready? They tell me we got 10% coupon. All right, what's the market rate? The market rate, 8%. Less than that coupon. So that means this bond is going to be issued at a premium. Above and beyond, we're going to collect more than the face value of $100,000. So the first thing you want to do is set yourself up. When you solve the math, if you don't collect more than $100,000, you know you did something wrong. So the bond's going to be issued at a premium. Let's see how we're going to find it. First thing I need to do is, what are my coupon payments again? So take your $100,000, multiply it by your 10%, your coupon rate, multiply that by a half. We'll be making payments of $5,000. How many payments are we going to make? Well, we got a 5-year term, 2 payments per year. So N is going to be 10. And then my market rate, 8%. 8% divided by 2, 4%. So now we're looking for the present value factor of 1 for the principal, corresponding to 4% and a number of periods of 10. And then a present value factor for an ordinary annuity to find the present value of the coupon payment. So let's see what the math looks like. Okay, so in this example with the bonds issued at a premium, you ready? We've got the $100,000 of principal, present value factor for a single cash flow being paid 10 periods from now. And remember, market rate, okay? Don't use the coupon rate. Market rate to find your discount factor. So that would be a discount factor gets us to $67,556. And then present value of the interest payments, $5,000 payment. I'm looking for the present value factor of an ordinary annuity corresponding to 10 periods, periodic market rate of 4%. The sum of the two, $108,111. So this is my financing inflow, $108,111. Notice my bonds payable is exactly what it was before. Whether the bonds are issued at a discount, a premium, or par, you're always going to repay the face value. So what's this additional $8,111? A premium. That'll be amortized over the life of the bond by reducing our interest expense, okay, which we'll see in the next example. So for right now, what does our balance sheet look like? We take in cash of $108,111. I got to repay someday $100,000. Your initial carrying value has got to equal the cash proceeds, $108,111. So as of right now, I have unamortized premium of $8,111. That's yet to be recorded. It's really a deferred gain. We'll use that to offset our interest expense over time. As we amortize this premium, as we add a smaller and smaller number, what's going to happen to our carrying value? It's going to go down until eventually it's $100,000. Then we repay the loan. So that's a premium. All right, our next example, bonds issued at, get out of here, discount. I'll show you it's a discount. Here we go. Coupon divided by price. What's your yield? Let's see, we offered the world a coupon of 10. The market said, you're crazy. I'm not buying your bonds unless you give me 12%. They want a higher rate. How are we going to get that world a higher rate? Well, they're not going to pay the face value. They're going to give us less than $100,000. So when bonds are issued at a discount, in English, that's really a deferred loss. That's going to increase our interest expense. But nonetheless, how do we find the cash proceeds? Exactly like we did with the two other examples. Tell me again, 5-year term, semi-annual pay. I need a present value factor for 10 periods, and then my interest rate, 12%, divided by 2. When I look for my present value factors, what are we looking for? 10 periods, and a periodic market rate of 6%. Present value of the principal plus the present value of the coupons, there's our cash inflow. Let's take a look. Alrighty, so for these bonds issued at a discount, I take the present value of my principal, present value factor of a single cash flow coming in 10 periods, market rate of 6%. Then I'm going to take my coupon payment, $5,000, times the present value factor of an ordinary annuity, $5,000 payment coming at the end of each 6 months over the next 5 years. So that's 10 total payments, market rate of 6%. The sum of the two, we were anticipating collecting less than $100,000. So we're in the right place. So our balance sheet, how much cash do we actually take in? Our financing inflow, $92,639. Notice premium, discount, or par. What are we always going to pay back at maturity? The face value, $100,000. Your initial carrying value has got to be the same thing as the cash collected, $92,639. What do we have here as of right now? An unrecorded discount, an unamortized discount, $7,361. So that's really a deferred loss. That'll cause our interest expense to be greater than our coupon payment. As we subtract the smaller and smaller number, what's going to happen to our carrying value? It'll get pulled up towards par over time. This carrying value stays on your books as non-current until we get within 12 months of paying it. Then that carrying value, well, then that would become a current liability. Okay, the carrying value times the market rated issuance is the way we'll get our interest expense on the income statement, whereas the coupon payments, the face value, times the coupon rate, and that'll be an operating outflow. But that's it. So you got a you got a bond issued at a premium, a discount, or par value. Don't ever do the math when the bond's issued at par, okay? We can save some time on the exam, discount or premium. We got to do it. Here we go, guys. Bond issue costs. You ready? 10% bonds are issued with the market rate is 12% again. So just like we saw, we're off in the world a coupon of 10. The market is demanding a higher rate of 12. Therefore, we're anticipating collecting less than that face value of $100,000. Now, the bonds pay interest again semi-annually, but this time we have bond issue costs of $5,000. So how do we incorporate that into our journal entry? Well, the first thing is I still have to find my cash proceeds when the bond is issued. So I take my present value of my principal, $55,839, the present value of my coupon payments, present value factor for an ordinary annuity, 10 periods, market rate. Here's my cash collected, the sum of the present value of the principal and the present value of the coupons. All right, here we go, guys. Same example we just saw. 10% bonds, but the market is demanding a rate of 12%, so we know the deal. With only offering the world a coupon of 10, but the market demanding a higher rate, we know these bonds are going to be issued at a discount. But here we're adding into the facts that we also have bond issue costs of $5,000. How do we account for that? Well, step number one remains the same. Find me the present value of the principal, 100,000, 10 periods, market rate of 12% divided by 2, 6%. And then find for me the present value of the coupon payments, 5,000. That's the present value factor for an ordinary annuity corresponding to 10 periods, market rate of 6%. The sum of the two is $92,639. But here's the problem. We don't get to keep all that money. You got to take that $92,639, and then you got to back out from that the bond issue costs of $5,000. So the cash received drops to $87,639. Okay, now notice no effect again on my bond payable. My bond payable is still what amount? $100,000. But now my discount consists of two items, the discount and the bond issuing costs. So that ends up being $12,361 as my discount. So looking at your balance sheet, we took in cash of $87,639. Face value, $100,000. Initial carrying value, $87,639. So my bond issue costs and my discount, $12,361. As we amortize that, what happens to the carrying value of my debt? It's pulled up towards par over time, and we're good to go. All right, let's try another example.